Hello, everybody. My name is Larry Drummond. I'm the Executive Director of the IPMI, and it is my pleasure to welcome you to the IPMI and New York chapter webinar. As you know, with the COVID-19 pandemic this year, we've had to cancel our New York Platinum Dinner, as well as the New York chapter's event that happens the same week. So today's webinar is to provide you with the content that you would have had in our live event in New York City. And we hope to see you at next year's live event in New York City, which will be held at the Grand Hyatt Hotel in New York. I'd like to give you a brief update, if you will, on what's going on in terms of scheduling with the IPMI. I think you've also have seen that we had tried to reschedule our conference to November, but given the rise in outbreaks over the summer, if you will, in the West and Southwest, our event in Las Vegas was, impossible to hold. So in its place, you have seen that we have announced that we will have a virtual conference November 16th and 17th. We have an exciting agenda that we're about to put out very shortly, and registration will open up for the virtual conference later next week. Additionally, there'll be a few other things. We are working with some of our committees in terms of scheduling committee meetings, and there will be some information coming out about our ERAC webinar fall meeting very soon. And also on schedule for early 2021 is our Public Affairs Legislative Seminar, which we hope to be able to hold in Washington, D.C. We'll have to see how things work out, but let's keep our fingers crossed that from a health perspective, things improve. Our next larger in-person event is the week of March 1st. We have 3 committee meetings in one place in Hollywood, Florida. Our Sampling and Analytical Committee, our newly formed PGM Refining Committee, and our Security and Anti-Money Laundering Committee. In April, we have an AutoCAT fuel cell seminar, which is scheduled to be held in Orlando, Florida. And then in June 12th to 15th to be exact, our annual conference in Peppermill. And I know I probably feel like a lot of you is that I'm really looking forward to the day that we can meet in person. But in the meantime, I think we're making the most of our virtual events and our virtual experiences together. And with that, before I introduce CJ, I'd like to publicly thank Miguel Santana Perez for his many years of service as the president of the New York chapter. As many of you know, Miguel is now the vice president of the overall IPMI International. And it gives me great pleasure to introduce our new president, CJ Zapri. And with that, CJ, I'll hand it over to you.
Thank you, Larry. Thank you for that. I'm very excited to be the president for Metro New York chapter of IPMI. And of course, thank you to Miguel as well for his longtime service for the Metro chapter as well as overall IPMI, I should say. So coming back to the webinar, thank you all for joining the first ever webinar organized by IPMI in tandem with Metro New York chapter of the IPMI. Well, I would say IPMI refuses to accept the status quo. Hence, we brought this webinar to you for bringing the precious metals fraternity together. This webinar serves as a great platform for all of us to stay connected and be in the know-how with the insights from the speakers that we have invited today. I would also like to thank Kitco and IPMI for their support to bring this webinar together. I would like to extend special thanks to Sandra to lend her support through difficult times that she has faced during this week. As you all know, Hurricane Sally did plow through Pensacola, and it wasn't the most favorable time for her, but thanks, Sandra, for your support on this. With that said, and taking much of your time further, I would like to introduce our first speaker, Mr. Jim Steele. I should say one thing. I don't think I need to introduce Jim. Jim has a stellar reputation as a precious metals analyst. For majority of us, we might have chosen profession to be in, whether it's sales or trading or whatever. At least I can say surely that for myself, that I chose this. But in Jim's case, I think the profession has chosen him to be an analyst for this particular industry. His style of presentation is envious, as he would present the most complex scenarios in the layman terms. I think this is something commendable. I'd like to I'll give the mic to Jim now, who's the chief precious metals analyst at HSBC, to take over and begin his presentation. We are going to do it in a different way. Let me share my screen, Jim, and then you just tell me whenever you want me to proceed, and I'll proceed to the next one, the next slide and all. Let me just take a moment to share the screen and Jim's presentation, and everybody should be able to see it. Yes, Jim, can you see the screen now?
I do not see it yet, CJ.
Okay. I am already sharing it. I guess the admin needs to just hit that button, and then we will be able to see it. I guess.
Yes, I do now.
Okay, cool.
Well, thank you. Firstly, CJ, thank you very much for those very kind and flattering words. I'm now in the hot seat. I have to make sure this presentation works well because of your very kind words. And also, thank you to Larry and Sandra for your gracious invitation, and Miguel, to talk to you again at the IPMI. I have many friends in the rank and file, and unfortunately, we can't all be together like in last year. But this is a stellar effort by the IPMI to continue on with these very important functions that really do help to keep the precious metals fraternity in a cohesive manner and get the word out on our markets. But enough of that. And I today will be talking about the fundamentals and the economic impacts on the gold market specifically. And we start off here with our HSBC lion. And we can go down to the next slide now, CJ. I think it's important to remember that broad things are impacting the gold market, and world events have a significant impact. Now, this can be rather confusing sometimes because, for example, things may happen such as Brexit, and the gold market rallies only $10 and then it gives up some ground afterwards. And I've had a lot of discussions with colleagues and clients and over the years who've said, Jim, do geopolitical events really impact gold? And my answer is that they do, but not necessarily any one event. And I think the key thing to remember here is that it's the frequency of events that's important. Now, the World Bank and the IMF or various other supranational institutions have definitions for what ranks as a geopolitical event. A geopolitical event has at least regional consequences and sometimes global consequences. And there is an excellent study out, Gold in Geopolitics, which talks about the sensitivity of gold to geopolitical events. And one of the points made is that it's not so much that any one event impacts gold, but if these events, if what ranks as a geopolitical event, that is to say, an event that has local, not just domestic, but regional and or global consequences, if you get more of them happening or ranked as that, then that is going to impact the gold market. And frankly, that is what's happened in the last few years. The geopolitical risk thermometer, if you like, has been rising. And that creates uncertainty. It has an impact on financial markets. And when you increase uncertainty, you tend to increase the demand for bullion. In the 1990s, for instance, and I know that seems like a very long time ago now, but because I'm very old, I remember it quite clearly. We had the end of the Cold War. We had the dissolution of the Soviet Union. We had a retracement and a decline in geopolitical risks around the world. And one of the consequences of this was that gold moved into a very long and prolonged bear market. Now, it wasn't the only reason, but that was a major reason. In the last number of years, in this century, in this last decade, the geopolitical risk thermometer is back up again. So depending on how you view things, do you think the world is going to get riskier, less riskier, more certain, more uncertain? You would have a view on gold. And it's easy to forget because it's also very difficult. You know, people like CJ and I and Jeff, we like to quantify things. We like numbers. And it's difficult to ascribe a number to geopolitical events and how that might impact the gold market. The next one, please, CJ.
Sure.
Well, this is something that I think is we're on more familiar ground with, which is Fed policy. Now, I would like to have, and I kept it from 2009 because I wanted it to be clear. You can go back as far as you want. You can also add in other central banks. But for the sake of clarity, I just put in one bank, the most influential one. And you can see clearly that as Fed policy becomes more and more accommodative, the gold market tends to increase. There's a number of reasons for that, but primarily the opportunity cost of owning gold is now very low. We have had unprecedented accommodative monetary policies and unconventional policies. This hasn't just been localized to the Fed. It is the ECB, it's the Bank of England, it's the Bank of Japan, it's many others in the emerging world as well. The combination of this massive amount of liquidity hasn't just gone into equities, hasn't just gone into the housing market. Some of it is finding its way into gold. And if you combine this with fiscal expansion, with this extraordinary amount of government spending around the world, then you're getting two important prerequisites for a gold rally: debt and liquidity. Debt from increased government spending, liquidity from central bank policy. Very often, you don't get both of them together. In fact, sometimes they're offsetting. Sometimes the central bank would be likely to say, well, there's a lot of fiscal stimulation going on, so therefore we don't need so much monetary accommodation. Or the government might say, we don't need to spend as much to stimulate the economy because our own central bank is already doing that for us. But right now, we're getting both. So this is a double impact on the gold market, which if you combine with geopolitical risk, or at least uncertainty, is driving us higher. When you have low interest rates, you do not have an opportunity cost of owning gold. That was the main reason that gold prices were low in the 1990s and earlier this century. You could get a fair amount of yield from a treasury. Why would you want to buy gold? I can understand that. And it's a very valid point. But now yields are low. There's a search for yield. The search for yield itself can lead to uncertainty, may lead to bigger risk-taking. That risk-taking can be defrayed if you search for a quote-unquote safe haven or hard asset. Gold is a premier hard asset because in addition to being a hard asset, it has liquidity. I mean, there's many other hard assets in the world, such as Canadian farmland, and I'm just using that as an example. It's a hard asset, but you can't liquidate it very quickly necessarily, but you can with gold. So the combination of this has really led to these record high prices in the gold market, and I think it's quite logical. The other point I'd like to make on this is that many people seem to think, or many people ascribe the rally this year to the impact of COVID-19, and I think that's absolutely correct, because it has been the fiscal and monetary response to COVID-19, to the pandemic, in order to save the global economy. that has boosted gold. But the gold market rallied 18% last year, 17 or 18%, and most of it from August. And that was before COVID-19 only came on the radar from the middle of December. So why did the market rally before that? The market, my point is, the market was we were already in a well-entrenched bull market ahead of COVID-19. And that was because of trade risk, geopolitical risk, and monetary easing. Factors which are carrying over and reinforce this COVID-19 led rally. May I have the next one, CJ, please?
Yeah, sure.
Now, here's a good example of the sensitivity of gold to yields. This is the real yield for the 10-year. So basically, it's the yield on the 10-year minus inflation. And we inverted the yield so that you could see the more negative, the further up the line goes, the more negative. And you see here, this is a lovely, speaking as a jaundiced statistician at one time in my life, this is a lovely fit. And you see how sensitive yields are. Now, if you think yields are going to stay low, this market's going to be well supported. If you think they can go lower, we could go higher. We at least know from what the Fed has said and from what other central banks have intimated that we're going to have low rates going forward. I realize this is the 10-year and the Fed doesn't control the 10-year, but they are keeping the shorter end of the curve low. And this is reaching out to the rest of the curve. So if you think that yields are going to remain low, then the gold is likely to be well supported. And if I could trouble you for but I think there's a beautiful, beautiful looking slide. I think it explains a lot. Sorry, DJ, I'm messing you around here.
No worries at all.
We can do the next one. Now, where is all this money going? Because it's not going into jewelry. It's not going into other forms of some forms of physical investment. Much of this money that is coming into the bullion market, this investment, is coming in through the ETFs, which have been quite remarkably buoyant. We started this year at about 81.5 million ounces for combined ETF holdings around the world, and we have a strict definition on what an ETF is. It has to be physically backed, and now we have around 109.5 million ounces. I believe 28 million ounces higher. It's an enormous increase in less than a year. I mean, we have gone up by between a third and a half of the holdings that we had from last year. And here is the gold price against the two largest ETFs, and we ran a regression analysis here, and you see, getting back to statistics again, this is a beautiful fit. The R squared is almost 0.9. If you think the world is going to be uncertain enough and risky enough for money to keep coming into the ETFs, the gold is going to be well supported. Now, the ETFs can be fickle. We did have a decline in March, and we had significant declines earlier in the decade when it appeared that Fed policy was going to shift in 2012. We got a large exodus out of the ETFs then, but that gold was purchased, a lot of it was purchased as China became an emerging buyer. But if you don't think Fed policy is going to change radically anyway, then there would be, that would discount one of the reasons for any kind of major exodus out of the ETFs. There's also always a core audience in the ETF that will hold it no matter what. And but right now the ETFs are very, very high. Up to recently, they've continued to accumulate, and this has had quite a positive impact on the gold market. We can do the next one.
Sure.
Now, one of the things I was trying to think of about the presentation today was, what's new? What can I say that's different? What can I say that's interesting? Gold is quoted in the Old Testament. It's quoted in the New Testament. It's talked about and as is silver more so in the Quran. It's talked about in holy texts in India and in China. What could we possibly have to add when people have been writing about gold for 5,000 years or more? And the biggest job of a precious metals analyst is, to some degree, is to be original. Because somebody is very likely to have already said in another form what you're trying to express. But I thought I would look at trade. And these are percentages of trade increases or declines in the major economic blocks in the world. And we put that against the gold price. And again, the data does go back much further, but I think this is pretty clear. Now, when trade is increasing rapidly at above average growth levels, economists tell us a number of things happen. One is inflation falls because the cheapest goods and services around the world are being traded. Number two, there's a lot of cross-border investment, a lot of cross-border immigration. Number three, the world grows quickly because of the theory of comparative advantage. Number four, you have to have a global economy that's in sync, because I have to be doing well in order to buy what you're selling abroad, from abroad. Paper markets rise. That's another thing. Equity markets do well, led by export-led companies. And the dollar tends to be firm because you need the dollar to conduct world trade. So if all of those, and unemployment tends to be low. So, and incomes tend to rise, particularly for the poorest levels of the world. So if all that's happening, why would you want to own gold? Well, you might want to own some of it, but much of the reason for owning gold is diminished. And that was the case, again, earlier in this century when trade was moving very rapidly higher, and in the 1990s. In the 1970s, trade was weak, gold market was strong. If you look at what happens when trade contracts, the gold market takes off. Now, it does it with a lag. It doesn't do it immediately, and I agree with that. But it does move higher. And when trade comes back down, the market moves again. Now, more recently, trade has moved lower. Now, the trade statistics are not as current as the gold statistics, but the point, this is a basic point that I'm trying to make, rather than to be too literal about the relationship between the two day by day. If you think that we're still in trouble with trade, then the market's likely to go higher. And if you notice last year, if you looked at any comments on trade that were positive, not just between the US and China, but between the US and other countries, between China and other countries, between the EU and the US, et cetera, the gold market tended to weaken. When trade tensions tended to rise, the gold market tended to rally. I think it's a very interesting way of looking at it. May I have another slide, CJ?
Sure.
Well, now we see also a different way of looking at this is the movement into the ETFs. And you see here in the red on the left side, or when you've got the first graph, we have the ETFs combined with the net long positions on the COMEX. And I already stated how much more we've had come in. And you really see here how the ETF demand has increased so sharply in the past couple of years, particularly from this year. It really has been quite remarkable. Now, the COMEX, the CME, the COMEX for us old veterans that keep calling it by its old name, is on the right. It's the gray bit on the first slide. And you see here, that is traditionally very volatile. And so very often, even though the number of ounces in being moved around by the futures and options markets, the exchange listed stuff, is less than in the ETFs. It can still be very influential on price because it tends to move more rapidly and more frequently than the ETF. But if you combine both of them, 28 million ounces and 109 million ounces, which is what the net long on the COMEX is, I think, at the moment. You're talking about 137 million ounces in visible investment, quite substantial. I can do the next one, CJ.
Sure.
Now, for every give, there's a pull, right? I mean, the market isn't going just one way. What has suffered because of these high prices, and what has suffered is physical demand, mostly in the emerging world and mostly in jewelry. Most jewelry is not purchased in North America or Western Europe or Japan. It's purchased in Asia. It's purchased in the emerging world. And these are price-sensitive economies. The average bar in India that's purchased is around 10 grams, sometimes 5. It can even be smaller. The average bar that's purchased in China is 50 grams or 100 grams. Not talking about a lot of gold per purchase. And also jewelry and investment tend to be blended in the emerging world, unlike the West, where jewelry is quite separate from an ETF or from a coin. Now, what has happened in the case of both China and India is that the high prices have pushed the consumer out of the market. The excellent work done by the World Gold Council and a Metals Focus that contribute data, I think, for them, shows that jewelry demand is down almost by half for the first half of this year. And jewelry demand is traditionally about 50% of all physical demand. So the jewelry demand has had a severe decline. And this is what happened back in 2011, 2012, when the market reached that 1920 level. The physical demand eroded. And the next slide will show that as well. That's India. And you see here that it's not quite as bad as the case with China, but Indian imports are down substantially as well. Now, it doesn't necessarily mean that the jewelry and the gold demand is as poor as the import demand, because there's a lot of domestic recycling that's done, and a lot of people are handing gold in, and that is supplying some of the market. But it's fair to say that all sorts of physical demand is down because of these high prices, and that is supplying a lot of the gold. And recycling is rising. And that happened as well, despite the fact that some of the refiners had to shut in March and April. So we have gold coming in, and we also have a lot above ground. So there's plenty to supply the market. Now the coin and bar demand is back up, and traditionally, as you get nearer a U.S. election, it's possible that it goes even higher. Although sometimes you get a pullback after the election. And I would just finish off by saying the other place where some spare gold can come in is from the central bank sector. That's not because they're selling, but we're seeing significantly less central bank buying this year than we did last year, which was a record high of 667 tons and 657 tons a year before. It's significantly reduced. Mostly because some central banks are use oil revenues, or the dollars earned from oil revenues help to buy the gold, and that's down this year. And other might be conserving dollars. There's maybe a whole range of reasons, but that also allows some gold to go into the investment side. And I think I wanted to keep at that 25-minute level or so, Larry. Okay. So I think that's about it, except for our disclosures, which have to be read line by everybody. 3 pages of them. But nonetheless, they are important. And I just want to thank everybody and hand it back to you, CJ, to moderate.
Thank you. Thanks, Jim. I've taken a lot of notes from that. I wanted to correct me if I'm wrong. Just one comment before we get into the question answer session and all. Sometime around 2000, up until 2000, from 2004 to 2009, 2010, the gold was hovering somewhere around from $600 to $700 an ounce. But I believe sometime in middle of 2008 or 2009, this Arab Spring happened, wherein there was one particular young kid was killed in a little country called Tunisia.
Yes.
And this whole thing started from there. And the entire 11 countries, like it went to Egypt, where Hosni Mubarak's government was toppled.
Yes.
Then it went on to Iran. Then there was a famous picture that went around the entire social media of a girl who was fighting into Iran, and she was, there was there was blood coming out of her face or something. There was so much of geopolitical. That's the point I was trying to drive home here.
Yes.
Because of the geopolitical issues, and back home, it was just the tip of the starting of the subprime mortgage crisis. And basically, Hank Paulson, he was on the press briefings every day. Ben Bernanke actually got really, importance from that point on. The Fed started keeping the interest rates low and so on and so forth. So geopolitical risks, along with the subprime mortgage crisis, really at that time, 2011, we saw gold reaching like $2,000 just for a day or a half a day or something, and silver reached all the way till $48, $49. But to your point, what you mentioned towards the beginning of your presentation, that geopolitical risk does play into the picture of higher gold prices. I completely agree with that.
Thank you very much, CJ. Yes, and that poor fellow, I think he was a fruit and vegetable seller.
Exactly.
In Tunisia.
Yeah. Right. Yeah.
It was quite tragic, but these things do feed through into the gold market, and as you said, this troika almost of fiscal spending, monetary easing, and geopolitical issues are sort of at the backseat a little bit compared to previously, but they're still supportive.
Right. Yeah. Larry, do you see any questions coming along?
I don't see one here now, but there was one question on if just your view, if you make the assumption that, let's say by year end or very early 2021, a vaccine is successfully introduced, Jim, what possible impact do you think that may have on the gold market?
Well, I think if one was credible and had been tested and was genuine, then that would have at least removed some level of uncertainty from the market, and that would be a negative for bullion. But the fiscal and monetary policies that are already well entrenched, it's like the Queen, like turning the Queen Mary. It doesn't happen quickly. And these policies will continue to wash through the economy for at least 2 more years. So even if a vaccine were to materialize, and let's hope to God that we do get one sooner rather than later, we would still have the debt and liquidity issue that would still be supporting the gold price. But without a doubt, I mean, not without it, you can never say without a doubt, but one would think that a credible vaccine that was widely distributed, that could measurably contain this pandemic, would have some level of a negative effect on gold. And
okay, the follow-up question obviously is the opposite. God forbid that this goes on and there's not a credible vaccine. What do you think the limit of where gold could go to is? I mean,
well, we're kept to our forecast, but the worse the situation would get if policies were not could not counter it. I mean, so far, governments, for all the criticism of government that we all have, governments around the world have, on balance, done a magnificent job in their fiscal and their monetary response. They really have headed off what could have been a potentially much worse situation. So I think the gold market would remain firm, but we'd have to see what would happen to equities.
Yes, exactly. Yeah. So what is the firm's forecast out? For.
Oh, we have an average of $1,965 for next year. But this year we have an end of year, and let me just make sure I've got the right. I want to make sure I've got the right one. We have an end of year of around 1950 this year, not too far, and the end of year next year for more like 1850, assuming some sort of moderation. So still historically very, very very high prices, an average of 1965 for next year, and high silver prices as well. And we have fairly wide ranges too. That's an important point. We're expecting the range for both silver and gold to be reasonably wide.
One question coming along is, how do you see the overall ETF market with or without vaccine? You think there would be a lot of inflows coming in, or because of the instability or other unknown, so to say, for future, given what we are going through, how's the ETF market going to be affected because of this?
Well, I think ETFs are reasonably firm, but unfortunately, I can't speak about a specific investment product. But what I can say, and you can, because ETFs have attracted a lot of the investment in gold, is I think the investment demand will remain strong. Okay. So you can draw from that something, but coins and bars,
right.
pretty good as well. But again, a lot of this is going to be, I see it more as the market being well supported on declines rather than us pushing ever higher and higher.
Right.
I think we've reached a point now where you can say that there's been a lot of, what's going to be new? What new is going to happen? We know what the fiscal response is. We know what the monetary response is. Now, to say what would happen if COVID gets much worse or much better is very, very hard to say, and I wouldn't really want to pontificate too much, because how long is a piece of string? How do we know it will get bad? We simply don't. All I can say is that the gold market is a good safe haven. It's a good quality. Yes. It's a good quality rather than a safe haven. It's better to say it's a good quality asset.
Yeah. Yeah.
I don't want to take up all the time for you and Jeff here, CJ.
No, we were just waiting in case if there is any other question coming along through YouTube or from anywhere our listeners are listening right now or witnessing the webinar. But if there are no questions, I get the comment that there are no more questions, Jim. So I on behalf of IPMI Metro New York chapter with board of directors that we have, I'm really thankful for you to take given this opportunity to present and giving your insightful presentation. Thank you so much, and your willingness to support this chapter.
An absolute pleasure, and thank you
so much. Thank you. Now that we have heard from a metal strategist, so to say, a chief metal analyst, we tried to mix it up with looking at the PGMs, and we all know how the pandemic has affected us in some shape or form, the industry overall. So it would be nice to get some insight from a trader who sees the movements of the metals on a day-to-day basis. With that said, I would like to invite the next speaker. He's Jeffrey Klein. He's a very good friend and a good colleague of mine. One thing I could say about Jeff is that I really admire his work ethic. I have known Jeff for about a little over 3 years now, ever since I've joined Heraeus. But it's been great pleasure to know him. Just to give you a quick background about Jeff, Jeff earned his bachelor's degree in economics from NYU. He began his career as a trader trainee with UBS in 1986. From there, he was promoted to a chief spot dealer on the precious metals desk. Since then, Jeff has worked in various senior roles with Credit Suisse, First Boston, New York Mercantile Exchange, Commerce Bank. His most recent stint before Heraeus ended in Luxembourg for Commerce Bank, where he supported them to transition their precious metals desk over there. Jeff joined as a senior trader with Heraeus trading desk in New York in 2016. He currently is managing PGM books for Heraeus Metals New York. I would now share Jeff's presentation. Jeff, you can hear us, right?
Yes. Can you hear me okay?
Yes, I can hear you.
Okay.
I think I'm going to share your presentation now. And just as we went with Jim, just tell me when to move to the next one, and I shall do so.
Okay,
Here you go, Jeff.
perfect.
This is your
Well,
presentation.
Well, thank you very much, CJ. Well, first off, I just would like to thank the IPMI, Larry, and Sandra and CJ for inviting me to this event today. Usually I go to the event when Miguel says, Jeff, I better see you at those the IPMI event, followed by those cocktail parties. So that's the teaser, and he gets me there. So this year it was very nice, even though we aren't all formally gathering together, which is sad. But at least we've set this setup, which I think is great for the community that we're involved in. And what a distinct honor to be on a panel with Mr. Jim Steele, the legend, who's well known throughout our markets. So it's an honor, and thank you very much. So I want to wish everyone first a happy Friday. It's another close to another volatile week. And as you can see on the title, historical volatility, we have witnessed in the last several months, or the last year per se, a record historical volatility, especially in the PGMs. We have had wild market swings. It seems on a daily basis, Palladium could trade anywhere from $50 to $100 range. So we're going to take a look at that over the last action we've seen over the last several months, and we're going to look at it from a trader's perspective and from a customer's perspective, because it affects both of us. Everyone always thinks with these wide markets, it's beneficial some people, hurts others, which is true. So we're going to analyze that a little bit. So let's go to the next slide, CJ, please.
Sure.
So these are the top quote is, as Jim, I'm sure knows, has heard it very well from famous economist Mr. Keynes, who said, markets can remain irrational longer than you can remain solvent. And this is so true. I've been in the markets now for a long time. As you mentioned, I started in the mid 80s. So like Jim mentioned, I lived through the bear markets of gold and platinum, and seeing gold trade below $300 an ounce. And then every hedger in the world selling future production, never thinking that gold could go up again. And then, of course, in the 2000s, we had the bull rally begin in gold. So what I really want to emphasize with this quote by Keynes is that, especially to our audience out there, hopefully there are some younger people out there, or maybe possible people who are considering going into trading, that no one is bigger than the market. Markets can go in directions, overshoot and undershoot, which they normally typically do, and they will remain irrational. So one key thing, it's easy for a trader to learn to, take a profit and ride a winning trade. But the hardest thing for a trader to do is to be able to take a loss and know when to take a loss and get out. So for any of the young people listening out there, that's my famous thing. Be very, very careful, and don't put yourself in front of a train. Know when to get out. I worked years ago. We had hired on a desk literally a rocket scientist from NASA, and he wrote this whole program. And one day he came in and I said, you won't believe where the markets are. It was a tremendous move in forwards and outright price. He goes to me, Jeff, this is impossible. It cannot be. I said, look at my blotter and I will show you the trades that I have done this morning. He lasted about 3 months, and then he went back to NASA. And he said, this is not for him, this business. So I've been in the trenches all these years. I wear the trading pains. And my quote, markets will always go to the point of most pain, which many times it does. When I've sat next to other traders, and you could see the pain in their faces. And usually when it reaches that point where they finally throw in the towel, that's usually the bottom of the market or the top of the market. Now, we've all bought the highs and all bought the lows, but the key is not to do it too many times. And luckily, I have survived all these years. I consider myself like a cockroach. I will always be a survivor. So next slide, please.
Sure.
And this is everyone has heard this phrase, a picture is worth 1,000 words. And if we can move on to the next slide, where everyone is looking at charts these days. You don't have to be a technician. You don't have to be a technical analysis expert, but everyone keeps an eye on the charts to know key price levels and to watch movements, because a lot of the system today, the word that has been introduced in the 2000s and our decade is algorithms. Algorithms dominate our markets now. They could read a news headline faster than a human being. It drives markets to extreme volatility. When you get the Fed coming out with beige book announcements, we get in gold, we could get $20, $30 ranges in literally minutes. So charts are very, very important. And I put up first the platinum chart we have here. And you could see, obviously, in March, in February, where we sort of peaked, and then in March when COVID hit us in the States. And it was very interesting. Everyone was talking about COVID in China in December, but there was sort of I think, the feeling, especially stateside, that, well, we're not going to get affected by this. And then when it finally started surfacing in the United States, we saw it spreading rapidly. And I think where we're going to show, if you could just skip 2 slides forward, CJ, to the stock market slide, which I think is
industrial, yeah.
Yes, and then Jim mentioned it in his presentation, where equities obviously plays a key role, and you could see that dramatic decline. Okay, you can see that dramatic decline that we had in February and March, and that was just after the Dow had made a new all-time high. But then when reality struck us in the States, we saw the virus hitting and the slowdown and the impact. And then the panic set in the PGMs, where we saw, and if you could go back to the first slide on platinum, we saw that peak, and then this rapid fall. And it refers back to Keynes, where people will say, oh, no, this is impossible. It cannot drop $500. Well, markets do that. They will do the irrational thing. So that's why people must trade with stops, and to learn to know when to get out and take a loss. And if you go to the next slide, Palladium, which had a dramatic fall as well, also had made a new high. And then we had this dramatic sell-off that takes place in March. And then slowly we've been coming back. And if you could go to the next slide, you'll see how this mirrors sort of with the stock market, where the stock market had that slide, and then we've creeped our way back, and equities, to a lot of people's amazement, is near record highs, not that far away, where we've had certain indexes setting highs. So that has helped PGMs come back. So we've seen quite a rapid, and we saw a massive decline, and then the coming back of metals. If you could go to the next slide, CJ, we'll hone in a little bit further, where Palladium on the end of February reached an all-time high of the 2883. And then in a number of days, it drops to a low of 1495 by March 16th. That's almost a $1,400 drop. So it's really quite spectacular. In these last 12 months, we've had close to a $1,400 range in Palladium, which historically, I mean, nothing is compared to that. And similar in platinum, where we reached not an all-time high. Platinum has sort of struggled, which we'll talk about a little later. But platinum reached a peak of 1,040 back in mid-January. And then with the equities market tanking, platinum dropped as well. We went down to a low of the 560s, and people thought we would never see something that low. They said the floor is 800. Well, markets become irrational at times, and this is what took place. So if you could go to the next slide, CJ, and I just want to highlight this one more time, especially in Palladium, over a 10-day trading period, 10 different trading days from March 12th to March 25th. You could see these daily ranges ranging from over $660 on March. That's a 28% drop in one day. I think if we saw something like that in the equities market today, you would have people jumping off of buildings. So in these 10 trading days, we had a session range trading to average of $316. So this is just a perfect example, once again, how markets can remain irrational. Next slide, please, CJ.
Sure.
So what does all this volatility mean? I mean, I deal with customers all day long, and they complain this is going, the volatility is extreme. And then this plus, when the volatility gets extreme, liquidity becomes an issue, especially in the PGM markets, where we're dealing with, we don't have the depth such as gold or silver. And when you get to a palladium market where you could have a volume of 2,000 to 3,000 contracts trading on a futures exchange, you see these extreme moves. With that, you get volatility and poor liquidity will equal wider spreads. As a dealer, one has to sort of play defense when we reach these high stages of volatility and poor liquidity. So spreads widen out, which for a trader is ideal, trading on wider spreads, because then you will get different people making different markets, and you're able to sort of capitalize on that. But there's also benefits for the customer as well, where it gives customers opportunities. At Heraeus, we're always speaking to our customers and saying, look, there is extreme volatility in this market. There is nothing wrong about leaving an order way below the market, because you never know what could happen. And I sort of compare this to if one is looking to been following a watch they want to buy, and let's say the price arbitrarily is $8,000, and one day you walk in and you see there's a flash sale for $4,000, you're going to jump all over that and purchase that watch that day. And the next day it's back up to 8,000. Well, if you have an order in down below in the market, and if you're a manufacturer and you budgeted X amount where your pricing is built in, and you have an opportunity to buy PGMs, platinum, palladium, several $100s because of an irrational market, one should take advantage of that. So we always stress that to our clients. During the palladium this past 6 months, we've seen spreads widen out, $30 to $50, platinum $10 to $20, and we've even seen electronic platforms which have been introduced over the last several years, where people have stopped pricing for the PGMs because of the volatility in these markets. Next slide, please.
Sure.
With this volatility, we've seen a dislocation that has taken place. There's been these normal relationships that have been in sync for years between futures and spot. And the PGMs we're trading from the industrial side, a lot of it is taking place in sponge. So there's this relationship between the sponge, and then from London, local Zurich, and local London, which is also a trading location for the PGMs. So for people got very comfortable with this relationship that existed between the futures and the spot, be it ingot or sponge. And we saw a dislocation take place over the last, we saw it first in Palladium back in 2018, where we had a squeeze in the market, where we saw Palladium lease rates jump up to 35%. Obviously, from a customer perspective, that hurts, especially when you're leasing metal at 35%. But we saw a dislocation take place when this happened, where everyone was in search of ingot, because there was a time in the market when there was tremendous demand coming in from Asia, and there was all the ingot was going out of the market being sent to Asia. So this created an opportunity, and it also created anxiety, and people were not happy when a customer calls us up and says, where can I lease metal? And you tell them the lease rate's 35%, and they're not happy. So we saw normal relationships toss out the window. And in this 2018, it was just sort of an early introduction to what was going to take place. Now, we've had Palladium squeezes in the past. Back many years ago, we had a major one, but this was the second one that we had seen in another time. And now, if you go to the next slide, CJ.
Sure.
Just to give everyone a background, in the Palladium and futures market, it's basically the New York market on futures is tied into delivery of a physical bar plate. It could be 50 ounces to 100 ounces, or you could make up as long as you have a minimum of 10 ounces. So when we have this dislocation taking place between sponge and Zurich, it gives traders an opportunity to take advantage of moving metal to various places. Now, what's very key is having the connections and relationships, which are so important in our market, be it with refineries, manufacturers, where you can take sponge and convert it into ingot so it can be delivered into local Zurich or local London. We talk about the EFP, which is the difference between the spot and the futures. And we saw dramatic levels take place in 2018, where it moved out to an $85 discount, where spot trading over futures. And then in this past January, we saw another major squeeze take place where the EFP blew out to a $300, minus $300. Spot was trading over. No one ever thought that they would see that. And you get these dramatic moves because at some point, risk managers, be it in a trading house or the banks, step in and say one must get out of their position. So that sort of adds fuel to the fire. And once again, markets will remain irrational longer than you can remain solvent. So limits were cut by banks because of these dramatic moves. But then, as always, things sort of calm down over time, and then things start trading back to where they normally were. So we saw going from a minus 300 EFP at times when we worked our way back where the curve moved to the right, where lending came in. People took advantage of this opportunity. And before, in several months, we were back to so-called normal markets. But it does present opportunities, and the disconnect is really something I want to stress here. When we saw that EFP and Palladium trading at minus $300, that was an implied yield of 96%, minus 96%, while the 1 month forward rate was trading at minus 35%. So if one has the connections, and then if you could take advantage of this from a trader's perspective, it presents tremendous opportunities. And I think for the most part, it's been a very, very good year for the trading community. But there were, unfortunately, some on the other side of this, which we'll talk about, where when COVID hit, I call it the perfect storm. If you go to the next slide, CJ.
Yep.
Thank you. So in the spring and summer, yes, I thank my daughter for putting that on my presentation. So COVID-19 hits, and we saw with the tanking of the metals, and I call it, it was the perfect storm. And it started in gold, where we saw there was a short US dollar funding squeeze. Even though rates have been close to zero, 25 basis points, we did spike because of a funding squeeze. We had all the major Swiss refineries shut down. We had South Africa close their mines with a force majeure. So there was a mad scramble. There was a fear that there wouldn't be, especially, and it started first in gold, which is the deepest market. I mean, Jim mentioned the tremendous volumes that had place in gold and the depth of that market. But there was a fear in gold that started snowballing, where the EFP will trade in a normal relationship to several dollars in gold. That rapidly started moving, and it moved from 3 to 6 to 9. And then the next thing you walked in one day and was trading 19. And that's when we saw all risk managers talking to their desk and saying, what is going on here? Because the natural position of trading houses is to be short the futures against long inventory. So you had a bailing out by many players sort of feeding on each other to try and cover short EFP positions. So that caused the EFP, if you could go to the next page, please.
Sure.
In gold to move out to $80, which was unheard of. Major losses, mark-to-market losses, were recorded by banks because they had publicly had to state these. Now, not everyone closed out their positions, because if you have a risk manager and a management who's of the understanding that you have the bars deliverable to deliver in against your short position, you have the protection. But a lot of times upper management and risk managers don't understand that mechanism. And before you know it, they want you closing out positions. So not everyone is always a winner. For every person who makes is always the losing side. But I just want to stress here just the volatility that we saw in this. And it's spilled over from gold into silver and then into the PGMs, where Palladium, which has been trading at a discount for the last 2 years, moved extremely far to the right to a positive $60, positive $80 range. So the extreme volatility, once again, is something that we had never seen. It was, and I call it historical, especially in Palladium. Platinum EFP moved out to $45. So it once again presented opportunities from the trading side. And if you had those relationships, if you have the contacts, the refining companies, and you can make bars to deliver in, one from a trading perspective can take advantage of these opportunities. So on the last page, please, CJ.
Sure.
Thank you. So just to sum up briefly, we've never quite seen a year such of volatility in all four major metals. And I haven't even touched upon rhodium. Rhodium moved from 4,000 up to 14,000. PGMs obviously are used in the catalytic converters in the car industry, and with a higher standard emissions globally, we saw higher loadings that are needed in these catalysts. So because supply demand issues became the true criteria in the PGMs, we saw the market moving to all-time highs in palladium. Of course, we then had our COVID-19, where fear of a global economic slowdown weighed on everyone, and then it just fueled itself. And from those earlier slides, we saw how much that market sold off. But now that things are starting to come back on again, China is producing cars. People are buying cars again. It's picking up back up in the States again. We have seen the market come back. This week, Palladium traded back above 2,400. Platinum is still relatively weak. It's been in a sort of a range between 850 and 1,000. What Jim mentioned as far as the demand, the gold, we've seen that spill over a little bit into platinum, where people have taken advantage of this, thinking that platinum is relatively cheap to gold, where it's trading at $1,000 discount. So we at Arrayas have seen tremendous demand in investment bars in platinum over the last 6 months. We've seen very good demand in gold investment bars and kilo bars as well. So I think, as Jim said, that will remain there. Obviously, we're going to be in a low interest rate environment for the next several years, as the Fed came out this week. We have the geopolitical. We have our election coming up in another month and a half. So obviously, there's still going to be a lot of uncertainty. And with that, I think people will like and feel comfortable holding gold, holding the minor metals, PGM, platinum as an investment, and palladium. I think if things stay on track to be recovery, you're going to settle in palladium because of the supply demand issues at a higher price in this $2,000 to $2,500 range. Is this the new norm at the pricing? I think it definitely has changed the structure of this market. We've lost players over the years, and now for the larger banks that provide this sort of buffer where they could step in, they've sort of said, well, we will do this, but we're going to charge a higher rate for this. So this is increased volatility, it's increased spreads, and it's taken this normal relationship that we have all sort of got very comfortable with, and it's dislocated that. So I think that will remain with us for the time, for the future, for the next year or so. People have been talking about palladium because we've seen the futures market question. The open interest dropped to a low of over 7,000, only 7,000 contracts. Will that become a pure OTC market like the rhodium and ruthenium and iridium? That remains to be seen. But what I will tell you, we all know that our market is a boutique market. Relationships, I feel, are still very, very key in our market. To relationships you have with your banker, such as HSBC or your Arrayas trading company, is extremely important because we're working with our customers hand in hand. I think these markets have created opportunities on both sides. And like I mentioned earlier, customers have to take advantage of this because of this volatility. It's not only harmful, it creates opportunities. So I think, I still believe, even though everyone talks about algorithms in our market, because it's so physically dominated, that the role of a human trader is going to remain. And I think relationships are as key as ever. So I thank you for the time, and I look forward to definitely much more interesting markets going forward.
Thank you, Jeff. Jeff, I'm going to try and put a question in here. Hopefully this works.
Okay.
It popped in before. It's not popping in now. I'll ask the question. It's coming from Matt Watson. It says, I'm looking at the longer term outlook for autocatalyst demand, and I conclude rhodium and palladium will remain in structural deficit. Based on the market data you're seeing, Jeff, do you agree?
Yeah, I mean, I do think the reports that have been put out by the especially SFA have said we will be in structural deficit. Obviously, we've seen some more mines opening up shares because of the higher prices. So more production will be coming out of that. But I think we definitely going forward will see, with the higher demands from emission standards being put out by countries, that rhodium and palladium will remain structurally in deficit and prices will remain supported. I mean, today, the other day, literally, rhodium made a new all-time high. We traded at 14,500. It's backed off a little bit today. The last tight market is 13,700, 14,000. But you're looking at historically high prices. Palladium back up to $2,400, and it's not without. I think it's a pretty good chance that we could once again test the all-time highs.
Okay. I would say. Sorry, go ahead, Jim.
Just a real quick addition to what Jeff said, if that's okay, Larry. I agree entirely. I don't look at the rhodium as much, but definitely for the palladium, structural deficits, I think, are likely going forward, at least near term. And the market deficits, production consumption deficits in the past were plugged by Russian stockpiles, exports, which have been, as far as we can tell, largely exhausted, and more recently the drawdowns in the palladium ETFs, which are only now 500,000 ounces left. So we will have to look for above ground stocks that we are not aware of. When I say we know they're there, but we don't know exactly how much because there's not enough left. The palladium ETF went from 3.1 million to 500,000. As it was liquidated, and that's
I think it's down 11%, Jim, for the year. The palladium ETFs. Yep.
Yeah.
I have one comment to make. Thanks, Jeff, for this whole refresher of what happened in last 6 to 7 months, so to say. To me, it felt like this must have happened over the period of few decades or so. But I guess we all can give ourselves a pat on the back. We have survived this. In some shape or form, with these amount of changes, so to say, in the markets. I have one question for you, Jeff.
Mm-hmm.
What I think is, given the less and less of market makers in the market, how is that overall going to affect what is it going to have the repercussions on the market overall, given the fact that many people might fold, many companies may not be able to survive this and all?
Well, I think less market makers will definitely add to increased volatility and wider spreads, because if there are only a handful left, you're not going to continually to make a narrow price when your liquidity is not there, what it used to be. We've seen major players exit our market. And like I said earlier, where banks played that role of stepping in as a buffer, they will do that, but now at a higher cost. And I think that's going to definitely be the trend. I mean, I think the algos will do their intraday, magic that they attempt to do. But I think at the end of the day, when you see platforms sometimes shutting down because of dislocations taking place, when we see a gold EFP, if I told Jim that a gold EFP would trade $80, he would say I would be out of my mind. So we've seen these extreme things happen over the last several months, and it's not going to be the end. I really think that we're going to see continued volatility, and I call it the new norm. When silver EFP is trading 25 cents, and as always, things will calm down, but then we will get another round of these, and it's not going away.
There is one more comment from our dear Matt Watson, wherein he says, also, I think the demise of platinum industrial buying is overstated. Certainly, current investment support, but jewelry and diesel AutoCAD demand coupled with incredible emission standards jump onto the HDV, which is heavy diesel vehicles, I believe, help. And California Regulatory Board, I guess that's what CARB is going hard on all these heavy diesel vehicles and all. So I believe, do you see that impacting the platinum overall? Because
I mean, platinum, I think, is sort of caught in fundamentally. We've been talking about an oversupply in platinum for the last couple of years. And then on the other side, which I mentioned earlier, where we're seeing people taking advantage of platinum, thinking it's an opportunity where it's cheap relative to gold, and then from the investors' demand that has come in. I think platinum's basically we're in a defined range right now where it seems where we get down to the 825, 850 level. We've seen good consumer demand come in from the manufacturers who need it to make their products, be it medical components products. And then on the upside, we're seeing when we hit the 1,000 to 1,050 level, we get to selling. So I think if gold accelerates higher, platinum will go with it.
Go up, okay.
I think if we take out gold back above 2,000, go back to 2,200, yes, platinum will follow, but it's definitely going to be lagging. I think when people saw the gold platinum ratio, when that moved, where people said, no way platinum could go to 500 discount to gold. Look, we're at $950 discount, $1,000 discount, and it happens. Markets will remain irrational at times.
Okay. Do you have a further question, Larry, Jim, or anybody on the platform from YouTube or some? If you have any questions, please feel free to, I shouldn't use the word tweet, but, put it in there. So we should be posing that question. We can take a couple more, and I guess we can proceed to the conclusion of this webinar.
Looks like I think we're good. We're good here, CJ.
Okay. I thanks Jeff for your wonderful insights on the market.
Oh, thank you for having me.
And I do definitely agree that there is going to be a need for a human trader in the coming years, and I'm a big believer in that. Besides, thanks Jim as well to you also for your insightful presentation. And I from here I give it up to Larry to if he has any closing remarks. And we can conclude.
Jeff, just in addition to the need for a human trader, I always hope there's a need for a human analyst as well. That's a little bit more important for me specifically. But
right.
I just thought that just a quick word to those viewing. I mean, we got real good insight into how traders operate from Jeff. This is absolutely first-rate stuff. You are not going to learn that any other place than from someone like him, and benefiting from, when I say a real veteran, I don't mean he's old. And when I say battle scars, I don't mean that he's battered, but he's been through the wars, and this stuff you will not get any other place but someplace like the IPMI. So well done, Jeff. And
thank you, Jim.
Larry, for getting someone of Jeff's caliber.
Thank you very much.
Well, I want to thank all of you. You did a wonderful job and a great service to our members. So thank you all. And again, once again, I just wanted to remind everyone to be on the lookout for some upcoming information on our virtual conference. We're going to have many sessions touching all the metals and various other technical topics. So you'll see some new information come out on that very shortly. And we're looking forward to a great conference. All right, thanks everyone.
Awesome, thank you so much.
Thank you.
Thanks, Larry. Thanks all of you, Jeff, Jim. Take care.
Bye-bye.
Bye-bye. See you.